Good morning, good day, good evening, everyone, depending on the time of the day you're tuning in. This is the next episode of Hot Seat with Anna, and today we have the wonderful Ivy Cohen with us. And Ivy is a fractional CFO and also the owner and the founder of Business Profit Advisors, which is a company that offers all types of financial services to business owners, from bookkeeping to accounting to CFO services and advisory services. Welcome, Ivy.
Well, thank you so much for having me, Anna.
Thank you for being here. I don't know if you'll be as happy at the end of our recording because I'll be grilling you, asking you challenging questions today. And let's jump right in. I'm sure a lot of business owners come to you and say, well, my accountant says we're absolutely fine. Then you come in and, oh, actually, you're not that fine. So what numbers prove that they are wrong in 5 minutes to you?
So when you say accountant, typically a small business owner has hired somebody that they're calling their accountant. They've hired them to do their bookkeeping and prepare their tax returns. So when that person says their business is fine, it means their books are clean and their tax return has been timely filed. But what that person is not looking at is whether the business is healthy, sustainable, or profitable. But that's not what they're doing. That's not what you hired them to do. So in about 5 minutes, there's a few numbers that I look at to determine the health of a business. First, I look at cash flow. It's possible to have a profitable business that's in a cash flow crisis. You can have a very good looking P&L and a stressed bank account. And every time you run payroll, you're worried, and that's not fine. That's a warning sign. Second, I look at gross margin trends, not just today, but what it's been doing over the last 12 to 24 months. If revenue is growing and margins are quietly getting smaller, the business is actually getting weaker, not stronger. And that's another red flag. And the third thing I look at is owner pay. Is if the owner is paying themselves a market salary, and is the business still showing profit? Or is the business only working because the owner's underpaid and working nights and weekends? And if that's the case, it's not profitable. It's actually burnout disguised as success, and that's not doing fine. And to that point, a CPA that you hire to do your tax return is looking at owner pay in terms of your tax deduction and how it affects your taxes and what the IRS qualifies as owner pay. But again, if you're not paying yourself a market rate, that business is not essentially profitable on its own. So for a quick example, I worked with a business owner who said, oh, my accountant said we're doing great last year. We made money. So in 5 minutes, I saw that while the P&L made a profit, the owner had not paid themselves a real salary. Accounts receivable had doubled. Margins had dropped 3 points. And once we normalized for all that stuff, the business was actually losing money. And
Oh,
no one had explained that to the owner before. So it was a huge wake-up call. Um, so once I show a business owner the numbers and that the numbers actually run the business in a way they understand, the conversation shifts very quickly to strategy.
my goodness me, now I'm worried about my numbers. Actually, I'm gonna see what my market rate is because I'm pretty sure I'm underpaying myself for the amount of hours I work per week. Thank you. Um, Based on your experience, what kind of decision do owners keep making based on their gut feel when the numbers clearly say, no, don't do it?
So the decision I see owners making over and over based on gut feel is believing that if something is adding to the top line revenue and sales, that something is profitable. So they bring on a new client or service line or even just general revenue growth in itself, they equate that to business profitability. The phone is ringing, more invoices are going out, revenue is going up. They assume the business is making more money. But when we actually look at the numbers, that assumption can fall short very quickly. Because, as an example, I recently worked with a small business owner, brought on a huge new contract. So it boosts the revenue of the business hugely. But this
Mhm.
new contract was highly dependent on the owner. There was a lot of labor, a lot of rework. It was basically making a loss for the business, right? So it's not always the top line, it's really the bottom line. Meanwhile, that owner had a less glamorous, smaller service that was generating most of the profit and cash flow, covering the loss generated by this huge contract. So the owner's gut said, this is what's driving the business because it's driving the top line, but the numbers said, this is what's straining the business.
Yeah,
Um, yeah. So revenue is emotional and profit is mathematical.
I love that stuff. Revenue is emotional, profit mathematical. I'm gonna use it with my accountant, actually. I love it. So at what level, revenue level, does DIY finance turn from scrappy to plain stupid? And I know it took me, I'm one of the worst people to ask this question because it took me years to stop doing my own accounting because I have trust issues, and actually to hire an accountant, professional accountant to do it. So at what level do you think, at what type of revenue level do you actually need professional help?
So the answer surprises people because I'm not going to give you a dollar amount. Every business is different, every industry is different, and there's not an exact dollar amount at which you should stop doing your own books. Um, the point at which you should stop doing your own accounting is where the cost of not knowing your numbers is higher than the cost of getting help.
Mm,
So at the level of a very small business, maybe where you don't have any employees except the owner's close to the work, the transactions are simpler, mistakes are smaller, and they're easier to unwind. And you can get away with doing your things yourself or relying strictly on a bookkeeper and a tax accountant. But when the business gets more complex, more people, more clients, payroll, pricing variations, moving parts, decisions start to have real financial consequences. And a bad hire or an
mm,
underpriced service, mismanaging cash flow, it doesn't just hurt, it could actually steal your growth, create months of stress, um, and lots of other examples of things that aside from you not having clarity of your numbers and making bad decisions. If you're
mm,
caught up in the bookkeeping and trying to figure out what's going on financially, trying to pay bills, deal with vendors, collect accounts receivable, invoice customers, you know, if you're running out of time to do that, if those things are slipping, it's costing your business money if you're not invoicing customers, if you miss paying a vendor and create a bad relationship there. But also the time that you're spending doing that is time that you're not spending working on your business, working on your
mm,
pricing, your strategy. If the time you spent doing bookkeeping this month could have gotten out and grown your sales 10%, like that, you have to ask yourself, is it really worth it? Like
mhm.
to spend that time doing bookkeeping. So it's kind of the opportunity cost.
Yeah.
And yeah, when the DIY finance stops being scrappy and starts being risky, it's not because the owner's incapable. It's because the business has outgrown the owner's intuition. Scrappy is admirable, but once the business reaches a certain size, clarity beats hustle every time.
Yeah. No, I fully agree. And it's interesting how business owners sometimes avoid looking at certain reports. Like an accountant will force you to do so. But I remember I only looked at my P&L and I was like, wow, that's looking good. But then you look at some other reports and that's actually not looking that good or that profitable. So what's kind of one financial report most business owners try to avoid looking at as much as possible because it ruins their day every time they see it?
I actually find that business owners ignore all financial reports that they don't understand how to interpret. So typically, I find small business owners are regularly looking at reporting of sales
Mhm,
and they're regularly looking at their bank balance. And this gives them very limited information about their business, definitely not sufficient enough to make good decisions for the business. And once an owner understands how to read the cash flow statement, for example, it becomes incredibly empowering for them. It explains the anxiety that they've been feeling and that they couldn't really put their finger on. Like they're like, well, I'm profitable, but my sales are going up, but my profits are going down, or my P&L is showing a positive, but somehow I'm struggling to pay my employees. I don't know how I'm running out of cash all the time. And
mhm,
it turns their cash flow problems and mysteries and stress into something manageable and fixable.
mhm,
And at the end of the day, the numbers are not what's causing stress, it's the
mm.
uncertainty. And understanding your financial reports is what turns that uncertainty into control.
Thank you. Now, I know another department you have is bookkeeping, and your team and you fix messy books for living. What is the most expensive bookkeeping mistake that you keep seeing?
The most expensive bookkeeping mistake we keep seeing
Hmm.
by far is business owners thinking that messy books are just an inconvenience instead of a real financial risk.
Hmm.
Um, so a lot of owners just assume we'll clean it up later, or as long as the tax return gets filed, then we're okay. But messy books don't just create confusion, they actually cost money every single month. So when the books aren't accurate, owners are making the decisions in the dark. They're not seeing that margins have slipped. They don't see that certain clients or customers are actually losing money. They can't make pricing decisions. For example, I worked with a business that was profitable on their tax return, but the books, and I came in and they said, well, we're making a profit. But the books hadn't been reconciled properly in over a year. And they didn't understand why they were so tight on cash if they were so profitable. Well, when we looked at it, we saw that revenue was misstated, expenses were misclassified, and owner pay was buried all over the place. And this is a typical situation when the books aren't reconciled. This is what happens. And once we cleaned it up, the business went from making money to actually losing money to the tune of multiple six figures.
Oh, wow.
And the owner wasn't reckless. They were just making decisions based on bad data. They
Mhm,
thought they got, a tax return. It was misclassified as revenue. They thought their revenue was so much higher. So they did all this hiring
mhm,
and they overhired and it turned into eating through more than just all their profits.
mhm,
So another big cost shows up when owners need something important. All of a sudden they need a bank loan, they need an investor, they want to take their business to market. Messy books delays deals, reduces valuations, increases professional fees. Sometimes it kills opportunities entirely.
mm,
I've seen businesses lose real money simply because they couldn't produce clean financial statements when it mattered. And the irony is bookkeeping mistakes are usually cheap to fix early and incredibly expensive to ignore. Clean
mm.
books they don't just help your accountant, they protect your cash flow, support better decisions, and increase the value of your business. So again, the most expensive mistake isn't that one wrong entry or missed reconciliation. The expensive mistake is waiting too long to make sure you have clean numbers.
Gosh, I now feel, the need and the itch to go and start looking at my books, if I'm honest. Now, as a founder, I'm friends with a lot of other entrepreneurs, business owners, and everyone is talking about growth. Founders just love growth. So what growth metric makes you say, stop right now?
Okay. Well, I mean, I think all business owners love growth. And I think that the growth metric that's really alarming, where I want to pump the brakes, is when I see the revenue growing without the margin growing,
Mm,
especially when cash flow is getting worse at the same time.
mm,
So founders love, again, the top line growth, more customers, more sales, more activity. It feels like success. But when margins are flat or declining, that's not healthy growth. And it means the business is working harder for less money.
mm,
I've seen this play out so many times. The owner's very excited about the year over year top line growth. But when we slow down and look under the hood, the gross margin is eroding, labor costs are creeping up. There have been no price increases associated with those labor costs. Cash is tighter than it was, and the owner is busier. Everyone is more stressed and somehow making less money.
mm,
That's the moment to hit the brakes, to go in and evaluate what is really going on and where you need to really grow and not just at all the whole top line, because growth amplifies whatever already exists. So if your
mm,
pricing is off, growth makes it worse. If your process is inefficient, magnifies that inefficiency. If your team structure isn't right, growth creates chaos instead of leverage. Um, so the metric I really want to see alongside revenue is profit per dollar growth and cash generated, not just sales booked. And again, if those numbers aren't improving, the growth isn't helping, it is hurting. There's one exception. I've had some of my startup clients say to me, but we're a startup. And so we're not focused on profit. We're focused on top line because the valuation and this. And there is an exception for startups, but it's a very narrow one. And it only works if it's intentional. So early stage startups are often sacrificing profit because they're trading it for learning. And they're
mm,
accepting lower margins or losses in order to validate a product, test the pricing, prove demand. And so in that context, revenue growth without margin growth is is understandable because everyone understands what's happening, how long it's supposed to last, and understands the path for profitability. The red flag for me is when a business says it's acting like a startup, but it's not actually experimenting. It's just growing without discipline.
mhm,
So where I say stop, even for startups, is when revenue is growing, cash burn is accelerating, and no one can clearly explain the path to profitability.
mhm.
That's not strategy, that's operating on hope. And so, yeah, startups get more grace, but they don't get a free pass on understanding their numbers because growth without profit can be a phase. Growth without a plan is a huge problem, no matter how early stage.
Thank you. Now, I know that you work a lot with family-owned businesses as well. what is kind of one conversation about money that families tend to avoid until the damage is done?
Generally, the conversation, the families, this is very sad because it actually impacts the family relationships hugely in a negative way. Families are generally avoiding all conversations about money, but really what they're avoiding is how money roles and expectations actually work inside the family. And they're avoiding talking about things like compensation, decision-making authority. It's uncomfortable to do that for them between family, and they assume everyone's on the same page. But the silence creates the problems later. And everyone's not on the same page. And a parent might assume a child that's working in the business understands that they're getting paid below market for now. But the child assumes I'm sacrificing today for a big payout something later. And no one defines what later means, and resentment builds. There's also, not having the conversation about the roles. A younger child in a family might be given a bigger role than an older child that was in the business first, or someone might be doing more work than another person. And all these things, when they're not talked about and defined, are building resentment in the family. And it's breaking down the family relationships. And it might not be apparent at first in the business, but I find after working with family businesses for almost 25 years, the business operations are going to reflect any discord in the family. So it's important that the family talks about money and roles in the business. It's important for the family and the business.
Thank you. So we all worked with good bookkeepers, good accountants, and also the bad ones. Yeah, you hear all sorts of horror stories about the IRS audit coming in and everything is a mess. So in your opinion, from what you see on a day-to-day basis, at what point should we fire our CPA or bookkeeper, even if we really like them personally? A lot of people say, well, I trust my bookkeeper. We've been with this bookkeeper for 20 years. So I feel there is this big emotional attachment because obviously money is involved. So it trusts that person. But sometimes you kind of scaled and scaled beyond their capability. For example, and then people just holding on to those people and they're kind of holding them back. So at what stage do you feel business owners should consider replacing their bookkeeper with CPA?
Replacing their bookkeeper with someone who's doing like more accrual basis accounting, you're saying?
Well, we work with CPAs for taxes, right? And bookkeeper for books. So at what point should we consider firing them? What would be the red flag for you coming in and recommending, well, your bookkeeper is actually not serving you well, or your CPA is actually not getting you the best results?
Okay, so I'm going to give you two separate answers on this one. The
Okay.
CPA that's preparing the tax return, I'm going to answer separately from the bookkeeper.
Okay.
The answer at the end of the day is you're going to like and trust both those people you work with. They work with your money, so you feel genuinely trusting of them. You may like them as a person, but both of them are able to outgrow your business, just like any employee or anyone within your business. So it's important to consider, your business as priority and have the best person that can help you working with you. So for the bookkeeper, the biggest sign I see is when the owner still doesn't understand their numbers. If they're months behind on the financials, if you're not getting numbers timely, or you get reports you don't trust, like I've had owners say to me, well, I got this report, but then the numbers changed since last month. Like last month's numbers changed on this report, so I don't know what's going on. If you don't know how to use the reports, so that's all a problem. Um, for tax, um, if their definition of success is the tax return is filed, but you're left guessing about your tax kind of planning situation. So what I typically see with tax, and I do find sometimes that the tax return is completed incorrectly. And I let my clients know that basically they need someone else because this person completed it incorrectly because it's kind of beyond their skill set. The business has grown into doing something more complex than it was doing when that person started preparing the tax return. So there's the risk that you outgrow them and then they're making mistakes and the tax return's wrong. Another reason that you might need a new CPA to do your tax return is because the CPA you hired to do the tax return is just doing the tax return and they're only focused on compliance, meaning making sure it's correct and it's filed timely. What you want at a certain point as a business owner is someone who's talking to you in the fourth quarter, maybe every quarter of the year, or at least in the fourth quarter minimum, about your tax planning strategy. How much are you going to pay yourself as an owner? What are you going
Mm,
to take as a deduction? Do you need to open other entities? How are those entities taxed? What is their structure? How do your personal taxes tie in? There's a lot of ways that as a business owner, you can control your tax situation. And so you can have a professional help you figure out how to do that. Also, when my clients are um, passing the business down from one generation to the next,
mhm,
you need a very good tax strategist to help you with that tax
mm,
planning.
mm,
Or when they're thinking about a merger or acquisition, you need someone who can help you strategize how to deal with that capital gain, how to make the transaction most beneficial to you tax-wise. So
mm,
if you're thinking about any kind of bringing on a partner, if you're thinking about any kind of transaction, you need some tax planning.
mhm,
And if your CPA who does your tax return doesn't do planning with you, at least at the end of the year, if not quarterly, that might be a sign that you need to get someone
mhm.
new, someone who deals with your size business.
So, Ivy, as you know, I'm sure all business owners have this one sacred cow expense. When you come in into companies, if you had to cut one sacred cow expense from most small businesses, what goes first and why?
It's not the same for every business. It's that legacy item that they're keeping for emotional reasons only that's not actually profitable. So it could be like the first version of their product, their first store location, their long tenured employees that they feel loyal to, that have been with them since the beginning. The phrase secret cow comes from the idea of something being untouchable, not
Mm,
because it's effective, but
mm,
because questioning it feels wrong. So
mm,
in business, you're not evaluating these things based on performance. And these things are protected by history, emotion, and identity. And they survive long after you stop making a profit on them financially. So that's why they're so dangerous. And so you have to ask yourself the questions like, are these expenses actually, giving me a return on my investment? Are they still meaningful? Are they still profitable? Because your past is what got you here, but it's your job to make sure it doesn't hold you back. So you need to identify those expenses and cut them.
I love it. I start thinking about finding my sister tomorrow. She has sacred cow expense. But we have so much fun working together that it's worth it. We work well together. So, Ivy, last question. I know I said it will be my last question, but I would like to know a little bit more about you. And I'm sure a lot of other people who know you want to know a little bit more about Ivy because Ivy is always a superhero of finance. Ivy is always collected, rational. Ivy is always reliable. What are the three things that make Ivy different from the collected, rational, professional Ivy? Can you give us a bit more insight into your personal life, your hobbies, things you do maybe outside work that people might be surprised to hear about you?
Okay, I'll give you three things, I guess
Okay.
that. So one thing that makes me unique, different from other professionals, is I come from a family of entrepreneurs and family-owned businesses. And when I realized I wanted to help small businesses was when my parents went to sell their small business when I was in my early 20s and I was working for PwC, valuing businesses for private equity firms. And I looked at their business valuation. I realized that small businesses can do better and they need help.
Mm,
And so my background from family-owned business is one thing. Second, I just have a 25 years of experience helping small business owners in accounting and finance. So it's just my operational experience in these size businesses through my whole career.
mhm.
And just for a fun fact, personally, I love swimming and I've been a master swimmer in my adult life. And my first business that I started I started it with some partners, a master swim team in New York City that we started in 2008 and it still exists today.
Oh, wow. What's a master swim team? I'm dying to know.
United States Master Swimming is an organization that just runs adult competitive swimming, basically. Anyone can be on a master swim team, from an Olympian to someone who's just starting, anyone over the age of 18.
Wow. Love it. So I assume you are originally from New York?
I'm originally from Miami. I lived in New York for 12 years
Oh,
as an adult.
mm. Well, thanks so much, Ivy. It was a pleasure grilling you on my podcast. I can let you in on a secret. Ivy thought it will be a podcast, so she didn't think we'll be recording on video. So we caught her unawares this morning, which gives me extra pleasure. Fire goes up. Thanks for your time, Ivy, and for sharing your knowledge. I personally learned a lot of things today. Took a lot of notes. I'll be taking some actions right away. So thanks so much for your time and for sharing your expertise.
Thank you so much for having me, Anna, and I appreciated it. And I
Thank
hope
you.
my advice has helped some business owners listening.
Well, here's one. Thank you.
Thank you.